So, you're waiting for interest rates to keep increasing so home prices can come down even more and you can finally buy a home. Ivaylo Stoyanov here with the Stoyanov Group, and in this video I want to go over with you guys some simple factors to see how accurate that statement really is. Let's talk about it. By now, we all know the correlation between interest rates and home prices, and we know that when interest rates go up, they decrease affordability and decrease demand, causing an imbalance in supply, how many homes are available on the market, to demand, how many buyers are looking to buy those homes. Even though this is true, in Canada that may be the case in the short term. However, that still does not fix our overwhelming supply issue of needing to build 1.5 million homes over the next 10 years, which in simple terms is as close to impossible as it can get given rising construction costs and labor shortages. Moving on to why the Bank of Canada is raising interest rates. Well, that's super easy. They're doing it to lower inflation. Inflation is sitting at 6.86% and their target inflation is 2 to 3%. The logic is that raising interest rates is going to decrease credit utilization, which will decrease spending, which will take money out of the system. It will lower demand, bring prices back down, which will lower inflation. Economics 101. So far so good, right? Well, let's take a look at the factors that are actually causing inflation. Even though cheap credit was a big factor that was causing inflation, nobody's looking at credit as cheap anymore at these interest rates. Of course, we know that rising oil prices, increase in money supply and savings, rising wages, and supply chain disruptions are all big causes for inflation. So let's take a look at how raising inflation will help or not help lower inflation based on these factors. We all know that raising interest rates has already cut homebuyer demand by 50%. However, that's already happened. Raising inflation will not cut oil prices, as we know that's not the driving factor behind the currently high oil prices. Rising interest rates have already decreased money supply and savings, and average Canadian is already feeling the pinch. We know that rising interest rates are not going to have a dramatic effect on rising wages and supply chain disruptions. So, what are going to be some of the effects of rising interest rates on inflation moving forward? The answer is very limited as to why the Bank of Canada will most likely raise their overnight rate to 3.75 or 4% and then stop. Why does that make sense? Well, in order to answer that, we're going to have to take a deeper look into the contributors to Canada's GDP. I'm sure you already guessed it, but I'm going to say it anyways. Real estate is the biggest contributor to Canada's GDP numbers. Even though the Bank of Canada is collecting more interest on the money they've already lent out, real estate transactions have already decreased by 50%, which means that they're lending out significantly less money, which will cause a deficit in interest collection. Overall, I believe that moving forward, we're probably not going to see an interest rate higher than 3.75 or 4%, as the Bank of Canada is not going to be helping to fight inflation if they raise it past that. However, they will be hurting the economy and the already hurt consumer. I hope that this was of value to you. Our goal is to provide you with unbiased information to help with your decision to buy, sell, or invest. As always, if you or anybody you know is looking for a great real estate agent, just give me a call and I'll take care of the rest. Cheers.